A woman in New Jersey wanted to do the right thing for her daughter, driven by deep maternal protective instincts and a desire to make life easier for her family after she was gone. She was 80 years old in reasonable health, but terrified of the legal system and the horror stories she had heard from friends about families spending years in court, losing tens of thousands of dollars to lawyers, and dealing with the endless hassle of settling an estate. So she made a decision based entirely on the best intentions, believing she was being incredibly smart and proactive. She went to the local county clerk, filled out a simple quitclaim deed, and legally transferred her home entirely into her daughter's name. She thought the house was a gift. She thought there would be no taxes. She was wrong. 4 years later, she passed away quietly, and her daughter, who had just had her second child, decided to sell the house to fund her own children's future college education and perhaps buy a slightly larger home for her growing family. She was expecting a smooth, simple transaction, completely free and clear of any government interference. Instead, she was hit with a devastating tax bill that completely derailed her financial plans. The federal government and the state demanded exactly $72,000 to $75,000 in capital gains taxes. She was in tears. Her mother's desperate attempt to protect her had backfired terribly, and a massive chunk of that generational wealth was just completely erased in an instant. This is a critical and dangerous mistake that happens every single day across the country, and the most tragic part is that it is completely avoidable if you simply understand the rules of the game. If you want to protect your family from this exact nightmare, avoid unnecessary taxes, and ensure your children actually receive the wealth you spent a lifetime building, you need to understand the complex legal framework governing property transfers. I break down the obscure tax rules, the hidden legal loopholes, and the dangerous traps that nobody else is explaining so you can keep your money safe from the Internal Revenue Service. Hit the subscribe button right now. Hit the like button right now. It takes 1 second, and it helps me continue to bring you this vital free financial education so you can protect your legacy. Now here is the part that changes everything, the fundamental concept that explains exactly why this mother made such a devastating mistake. To truly grasp the magnitude of this error, you need to understand two highly technical terms that govern the transfer of property in the United States: cost basis and stepped-up basis. These two concepts are the absolute foundation of everything related to real estate taxes and inheritance. Cost basis is very simply the original value of an asset for tax purposes, plus any qualifying improvements you have made over the years. If you bought a modest house in 1982 for $45,000, your original cost basis is exactly $45,000. If you spend $25,000 10 years later on major permanent improvements like a new roof, a kitchen renovation, or a structural addition, your cost basis officially goes up to $70,000. Now let us say that exact same house is worth $470,000 today in the current real estate market. If you decide to sell that property while you are still alive, the IRS looks directly at the difference between your adjusted cost basis of $70,000 and the final sale price of $470,000. That difference is a massive $400,000. That $400,000 is your capital gain, and depending on whether it is your primary residence and if you meet certain criteria, a large portion of that could be subject to severe capital gains tax. Now, what happens if you decide to give that house away to your child while you are still breathing, just like the woman in New Jersey did? The IRS enforces a strict rule called carryover basis. This means your original low-cost basis transfers directly and automatically to the person receiving the gift. If your basis was only $70,000, your child's new cost basis is now legally and automatically stuck at $70,000, regardless of what the house is actually worth today. This brings us directly to Internal Revenue Code Section 1014, which introduces the incredibly powerful concept of the stepped-up basis. This is universally considered the ultimate tax loophole for passing down wealth from one generation to the next. If you simply hold on to the property in your own name until the day you die and your child inherits it through the proper legal channels, the cost basis is legally stepped up to the exact fair market value of the property on the specific date of your death. If the house is worth $470,000 when you pass away, your child's new legal cost basis is instantly $470,000. If they decide to sell that house the very next day, or even a few months later for $470,000, their taxable capital gain is exactly zero. The tax is zero. Done. They walk away with every single penny of the equity you built over decades. This stark, dramatic contrast between giving a property away while you are alive versus letting a child properly inherit it when you die is exactly where the $75,000 trap lies hidden, waiting to destroy your family's inheritance. Let me put real concrete numbers on this and walk you step by step through scenario 1 versus scenario 2 so you can see the exact math. In scenario 1, you decide you want to avoid probate so your kids do not have to deal with it, so you simply gift the house to your child today. You bought the house 30 years ago for $50,000. Today, because of inflation and market appreciation, it is worth $500,000. You go to a lawyer or a title company and sign the deed over. Your child now legally owns the house, but crucially, they also own your dangerously low $50,000 carryover basis. A few years later, you pass away. Your child, perhaps needing the money or simply not wanting to manage the property, goes to sell the house for its fair market value of $500,000. Because their legally recognized cost basis is only $50,000, they immediately trigger a taxable capital gain of $450,000. Depending on their specific income tax bracket, their marital status, and the state they happen to live in, they will likely pay a long-term capital gains tax rate of at least 15% at the federal level, plus potentially another 5 to 10% in state taxes. Let us just use 15% for the federal tax to keep the math simple. Multiply $450,000 by 15%, and you get exactly $67,500 owed directly to the IRS. Add in a modest state capital gains tax, and you are easily looking at a devastating tax bill of $72,000 to $75,000. $75,000 of your hard-earned equity, wealth that you scrubbed floors and worked overtime to build, is instantly erased because of one simple, well-intentioned mistake. Now look closely at scenario 2. You keep the house solely in your name. You set up the proper, legally binding estate planning documents, which we will discuss in great detail in just a minute, and eventually you pass away. Your child inherits the house legally upon your death. Because of the incredible power of the stepped-up basis under Internal Revenue Code Section 1014, their new cost basis instantly becomes the full $500,000. They sell the house shortly after your death for $500,000. The calculated gain is zero. The resulting tax is zero. They keep every single penny of that $500,000 to pay off their own debts, fund their children's education, or invest for their future. The financial difference between these two scenarios is absolutely staggering and life-changing. Now let me walk you through 3 more highly nuanced situations that legally trap families every single day because they listen to bad advice from friends or uninformed professionals. Scenario 3 involves the dangerous use of joint owners. Many parents think they can cleverly outsmart the entire legal and tax system by just adding their child's name to the property deed as a joint tenant with rights of survivorship. They mistakenly think this perfectly avoids probate while allowing them to seamlessly keep control of the home. But this is highly dangerous and legally complex. When you add your child to the deed as a joint owner, you are legally making an immediate gift of exactly half the property's value right then and there. If the house is currently worth $500,000, you just gifted $250,000 to your child. Consequently, your child takes your low carryover basis on their newly acquired half of the property. When you eventually die, they do get a stepped-up basis on the half you still owned and passed to them, but they are permanently stuck with the original, low basis on the half you gifted them years ago. When they finally go to sell the property, they will still face a massive, completely unnecessary capital gains tax bill on their specific portion. Scenario 4 involves the widely misunderstood irrevocable trust. People constantly hear rumors that an irrevocable trust is the ultimate way to protect assets from nursing homes and creditors, which is technically true, but they completely fail to realize the catastrophic tax implications if the trust is drafted incorrectly by an amateur. If you transfer your house into a standard irrevocable trust and legally give up all rights, control, and access to it, the IRS treats that transfer as a completed gift. Because it is a gift, the trust automatically takes your low carryover basis. When you eventually die and the trust either sells the house or distributes it outright to your children, there is absolutely no stepped-up basis available to them. They will owe the full, devastating capital gains tax on the entire appreciation of the property. There are highly specialized legal vehicles, specifically a Medicaid Asset Protection Trust, that utilizes a retained grantor trust status that can successfully protect the home from nursing homes while simultaneously preserving the crucial step-up in basis, but a basic, boilerplate, irrevocable trust will destroy it entirely. You must consult a highly qualified estate planning attorney to confirm your trust explicitly preserves the step-up. Scenario 5 involves the unique complexities of community property states. If you live in a state like California, Texas, Arizona, Nevada, or Washington, you are subject to incredibly unique and powerful marital property rules. In these community property states, if a married couple owns a home together, when the very first spouse dies, the entire property, not just the deceased spouse's half, gets a massive full double step-up in basis. This is incredibly powerful for surviving spouses who want to sell the home and downsize without paying a dime in taxes. But if you foolishly gifted the house to your kids before the first spouse died, you permanently threw away this massive double tax advantage. So, with all these traps surrounding you, What should you actually do instead to protect your family? Here are 4 concrete options, ranked objectively from worst to best, so you can make an informed decision. Option 4 is gifting the house outright while you are alive. As we have exhaustively proven with undeniable math, this is the absolute worst option available. Do not do it under any circumstances unless you have a highly specific, professionally guided tax strategy. Option 3 is relying solely on a last will and testament. A will does guarantee your children get the stepped-up basis because they officially inherit the property only after you die. However, a will absolutely guarantees your family will be forced to go through probate. Probate is a public, incredibly time-consuming, and notoriously expensive court process that freezes your assets for months or even years. Option 2 is utilizing a life estate deed. This specialized deed allows you to legally retain the absolute right to live in the house for the rest of your natural life, and upon your exact moment of death, the property automatically and instantly transfers to your children. Because you legally retained a life interest in the property, the IRS considers the home to be included in your gross estate, which means it legally qualifies for the full stepped-up basis under Internal Revenue Code Section 1014. It also successfully avoids the agonizing probate process. However, life estates can be incredibly rigid and problematic. If you ever decide you want to sell the house, downsize, or refinance the mortgage while you are still alive, you legally need your children's explicit permission and signatures. And if your children ever get sued or file for bankruptcy, their creditors could potentially place devastating liens directly on their remainder interest in your home. Option 1, the absolute best, gold standard choice for the vast majority of families, is establishing a revocable living trust. You legally transfer the deed of your house directly into the trust. You remain the sole trustee and the primary beneficiary while you are alive. You keep total, unyielding control over the asset. You can sell it, refinance it, rent it out, or completely change your mind and revoke the trust at any time without asking anyone's permission. When you eventually pass away, the house transfers immediately and privately to your children, completely outside of the sluggish probate court system. And critically, because you retain total control over the asset during your lifetime, the IRS officially considers it part of your taxable estate, granting your children the full, wealth-preserving, stepped-up basis. It is the perfect, elegant solution to a massive financial problem. Now, we must directly address some secondary, highly confusing issues that constantly mislead well-intentioned people, specifically the dreaded Medicaid penalties, the real math of probate costs versus tax costs, and the pervasive myths surrounding estate taxes. First, let us talk about the brutal Medicaid 5-year look-back period. Many elderly parents desperately give their house to their kids because they want to impoverish themselves on paper to quickly qualify for Medicaid to pay for an exorbitant nursing home facility. But Medicaid rigorously looks back at absolutely all financial gifts and transfers made within the last 5 years. If you give your house away today and suddenly need nursing home care 3 years from now, you will face a devastating, mathematically calculated penalty period where Medicaid will flat out refuse to pay a single dime for your care. Your kids might literally have to sell the very house you gifted them just to pay out of pocket for your medical care, and because you gifted it to them, they will simultaneously be forced to pay massive capital gains taxes on that forced sale. It is an absolute nightmare scenario that ruins families. Second, let us logically address the core emotional objection that drives all of this. I want to avoid probate so my kids do not have to deal with it. People are understandably terrified of probate costs, which, depending on your state and the complexity of your estate, might reasonably be $10,000 to $15,000 in lawyer fees and court costs. So in a panic, they give the house away to desperately avoid a $15,000 probate fee. But in doing so, as we have clearly seen, they automatically create a massive $75,000 tax bill for their children. The ultimate crushing realization here is that the cure was vastly worse than the disease itself. You aggressively tried to save your children $15,000 and unintentionally ended up costing them $75,000. Finally, there is the persistent, misleading estate tax myth. Everyday people falsely think that if they die proudly owning a house, the federal government will ruthlessly swoop in and take half of its value in estate taxes or death taxes. Under current federal tax law, the lifetime estate tax exemption is well over $13 million per single person, or $26 million for a married couple. Unless your overall net worth is significantly higher than $13 million, your estate will not pay a single solitary penny in federal estate taxes when you die. Do not ever confuse estate taxes, which only ever hit the ultra-wealthy elite, with capital gains taxes, which ruthlessly hit everyday middle-class families who make poor, uninformed gifting decisions with their primary homes. We have covered a massive amount of dense, critical, and potentially life-changing information today, so I'm going to give you a highly pragmatic, straightforward 5-step action checklist to immediately apply these lessons to your own life and permanently protect your family's hard-earned wealth. Step 1. Go directly to your local county clerk's office physically or look up your official property records online right now and legally confirm exactly whose names are currently stamped on the deed to your house. Step 2. If you discover that you have already mistakenly added your children to the deed, consult a licensed tax professional or a specialized estate planning attorney immediately to see if the transaction can be legally undone, reversed, or financially mitigated before it is too late. Step 3. Calculate your current accurate cost basis. Write down exactly what you originally paid for the house decades ago and meticulously add the documented cost of any major permanent renovations you have completed over the years. Step 4. Multiply the current realistic fair market value of your house minus your calculated cost basis by roughly 15%. That final number is the exact devastating tax bill your kids will personally face if you foolishly gift them the property today instead of letting them inherit it. Step 5. Set up an immediate consultation with an experienced local estate planning attorney to professionally draft a revocable living trust, ensuring your house completely avoids the nightmare of probate while securely locking in the vital stepped-up basis for your heirs. Do not let tragically bad advice and an irrational fear of probate destroy the generational wealth you spent an entire lifetime building for your loved ones. If this video helped you finally understand the massive financial risks of putting your kids on your deed, hit the subscribe button right now. Hit the like button right now. It takes 1 second and it actively helps push this crucial wealth-saving information to other unsuspecting families who are right about to make a terrible, irreversible financial mistake. Drop a comment below. Have you already put your kids on the deed? Let me know your exact situation in the comments.